Welcome, everyone. This is our educational Zoom series where we explore different topics to gain financial literacy and achieve financial freedom. Today, we'll explore tax benefits of investing in multifamily syndications. And we have Denise Piazza with us today. Welcome, Denise.
Thank you. Thanks for having me, Deepa.
It's such a pleasure. So Denise is a managing partner of One Street Capital, a private equity real estate firm focused on acquiring real estate assets in growth markets across the country. Denise began working with the real estate industry over 20 years ago, and through several tax and accounting engagements with real estate clients while employed at a CPA firm. So Denise is a CPA. She's a general partner in 900 plus units of multifamily real estate and a limited partner in over 1,700 units. And she's raised millions of dollars of private equity, and she's involved with over $250 million in real estate transactions. So Denise, thank you so much for being here. And we've always wanted to have a CPA on so that our investor base can benefit from knowing what are the tax benefits from investing in real estate.
Sure. And I'll try my best not to put your listeners to sleep.
No, this is very invigorating because, passively investing in real estate, one of the advantages are tax benefits, right?
Right,
So if
right.
we understand how it benefits, then there's more invigoration within
Yes,
everybody to start investing.
absolutely. Absolutely. And the first thing that I tell people when I think about the tax benefits associated with real estate, one of the big things that you need to do is to engage a tax strategist or start thinking on your own about the tax strategies that allow you to maximize the benefits.
Got it.
Um, and so, that's the focus that I always bring back to people is because you want to make sure that you're leveraging all the key components, timing your capital gains with your capital, with your losses, and really being able to fully utilize the benefits that we all know and love about real estate.
Right. Thank you for that. That should be the first thing. But a lot of people have trouble with finding the right tax
Mhm.
strategist. What would you suggest?
Sure.
Where do we start?
So I would ask around within your network, if you're a real estate investor, whether it be passive or active, often a referral basis. I will caveat with saying that both my husband and I are CPAs. So we always say that our kids have no chance of being cool whatsoever. Um, but I often, refer people to my husband. He is very involved on the tax side as well. And he's been doing this for over 30 plus years now. And so, I would say you really want to interview your CPA. You want to make sure that you're not just getting someone who is inputting your numbers and your information into the tax software. You want to make sure that it's somebody that's meeting with you and working with you throughout the year to make sure that you're going to optimize your tax advantages and just understands the business that you're in. So
Right.
real estate investing and real estate active investors, there's a lot of nuances associated with that. One of which we're going to talk about today is the Schedule K-1. So it's important that you ask the right questions before you engage a CPA. And just like anything else, as I said initially, I always, appreciate a referral from someone in my network. As for anything that we're trying to find someone to do, we're trying to find someone to do work for us or for our business, we do the same thing. We get referrals, and when we don't have one that we feel real good about, we make sure that even if it is a referral, you want to make sure that you're asking your CPA the right questions.
Got it. Got it. And we also need to make sure that the CPA himself or herself is also a real estate investor
Yes.
because they understand the ins and outs better if they've been through it too.
Right, right, exactly. Yeah, I mean, and if they're not themselves, then I would say you want to make sure they have a substantial amount of clients that have real estate investments or holdings. Ask about the types of investors, the types of assets that they have, because multifamily might be different than another alternative investment. If somebody invests in alternative investment like oil and gas, that's different than real estate. So you just really want to make sure that they have an ample amount of experience with these types of holdings.
Got it. Great advice. Thank you. Should we jump on to K1s?
Yes, yes, I love it.
Okay. So for the listeners, Denise and I have come up with like simulation of one full cycle of a real estate syndication into a multifamily asset. And we'll just go through the year when it was invested, the K1, and then the year that the property was held, and the third year the property was sold. So we'll just go through all the three K1s. And Denise is going to walk us through the tax benefits and how to read a K1 and um, how to understand those numbers. What do they actually say? So let me start sharing my screen. Denise, please let me know. I can drive, and
Yes,
please let me
yes,
know.
yep,
To scroll or when
absolutely.
to
So
pause.
I can see your screen.
Okay, perfect.
And we can start on that page. But I'd love to just start out with a very high level background on what a K1 is before we dive into the specific sections that we wanted to discuss. So our tax code allows certain entities to be um, pass through taxation. And by utilizing this pass through taxation, the liability shifts from the partnership itself, in this case, to the people who have an interest in the partnership. So I think, this is the K1 from a limited partner, I believe. And the Schedule K1 is a reform that is going to report all the amounts that are passed through to each of the owners of this income producing entity. And so while the partnership itself is not subject to income tax, the individual partners, or in this case, the limited partners, are subject to the tax for their proportionate share of what the entity made. Commonly, a Schedule K1 is issued to taxpayers who've invested in these limited partnerships. So with that, Deepa, I'm going to focus on the areas that are relevant to this particular K1. 2019, based on my discussions and understanding for this example with Deepa, this is the first year that this individual invested into this multifamily real estate property. So you'll see that based on some of the information on the screen, you'll be able to see that there's beginning balances that are at zero. And, we'll talk about that a little bit more. But basically, that's because this is the first year of the investment. So the part 2 of this Schedule K1, there's a section J with information. My screen jumped for a second. The capital percentages on the bottom, they can be determined from taking your proportionate allocation in a given investment, and you take that amount divided by the total amount that was raised in private capital for that investment. So for example, if you contributed $100,000 to one opportunity, just for simple numbers, that raised $1 million in total capital, your ending capital percentage would be 10%. So in this example, it's a little over 1.3%. You can see that capital balance right there. And the loss percentage on the K1 is the same amount as their capital percentage. So basically, you're going to share in the proportionate losses of the business in the same ratio to your capital ownership percentage. And as we all remember, the benefit of investing in real estate for those of you who don't know, is that you can utilize one of the most powerful components of the tax code, which is something called depreciation. So essentially, when you buy these buildings and these assets, it allows you to accelerate your depreciation, basically your write-off of the value of that asset for what you acquired it for. So that in the tax code, in the tax world, you're going to be showing paper losses, even though your entity itself is an income producing entity, which is such a benefit because you're, let's just say, again, for ease of numbers and the easy example, you invest $100,000, you're getting cash on that, and via a distribution of 10%, that's $10,000 a year of passive income, but you're going to actually, from a tax perspective, show a net loss on that property when you acquire it. The profit allocation for this particular property is slightly different than the capital and the loss percentage. And the amount of the profit allocation is really determined by the partnership agreement itself. Without having direct access to the partnership agreement, I'm not sure why the amounts differ slightly from the capital percentage, but that amount would be dictated within the partnership agreement itself. So when you invest in an opportunity, you receive a PPM document, private placement memorandum, and it's very important to read through that document and make sure you ask questions and understand your particular partnership agreement. And then skipping down to section K, and I'll just pause there, Deepa. Do you have any questions on section J? Anything I didn't cover?
No, that was really good.
Okay. Okay. Please feel free to interrupt me if I'm not
will do.
If I'm not being clear.
Thank you.
So for section K, you should what that should show you is your share of the partnership's non-recourse liabilities, and their qualified non-recourse financing, and any recourse liabilities at the beginning and at the end of the partnership year. So again, this property was acquired in 2019. The beginning of the year balances are all zero. But however, there is a balance at the end of the year. And what that is, what the qualified non-recourse financing is, it's financing that's secured by real property, aka the asset itself, that's used in the activity of holding property, and it's subject to at-risk rules, which we'll talk about later in the K1, which basically factors into your tax basis for the property. This qualified non-recourse financing includes financing for which no one is actually personally liable for the repayment of in an activity of holding this real property. So, again, one of the benefits of being a limited partner is you don't have the same liability as the general partners themselves. So you have no, there's no recourse liability to you for this particular loan.
So Denise, over here, the where it says recourse, for now it's empty. Should it be empty for all the LP K1s?
Yes.
Always?
Yes.
Got
As
it.
far as I've ever seen, now I don't invest in properties typically with recourse loans. Typically the ones that I've invested in are non-recourse. So I can certainly ask if I can take a look and see if their general partner had a personal recourse loan associated with it. I would expect that number to still be zero because a limited partner themselves would not have any
Liability.
direct liability associated with it.
Got it. Thank you.
Sure. And again, you'll notice that is zero, and the partner's recourse liability is any partnership liability for which the partner is personally liable. And again, as we said, this is a limited partners K1, someone who's just investing in the property itself. So hence there is no personal recourse liability. And these amounts should represent your ownership percentage in the property multiplied by the respective financing amount for each of the three categories. So again, that's how those actual balances on the schedule of in section K of 1387 and 48-17, that's how they're calculated.
Got it.
Okay, so then that gets us to the next section. And this is a section that really references your particular capital account on a property. The beginning capital at the beginning of the year was 0 because during 2019, that's when you invested the $50,000, not you particular Deepa, but this particular limited partner invested $50,000 into the property itself. So that's your capital contributed. And then your current year net income or loss. Remember, as I said, one of the main benefits is investing in real estate is the paper losses we can recognize because of that powerful tool of depreciation. We're able to accelerate that depreciation during our investment hold period by performing something called a cost segregation property. And that's just a fancy way of saying that it's allowing us to take additional depreciation early in the life of a property. The withdrawals and distribution. So should you receive any cash distribution from this property during your hold period, this is where it would be displayed. Whether it was, your share of net operating income or how much the property made, or some other sort of distribution, this would all be reflected in this section. So I believe, in particular to this property, this 539 is the distribution that was received.
Right.
Yes. And then the ending capital is really just the sum of all these items above to get you to your ending capital balance for the property.
Got it. Okay.
Okay, so let's then jump to part 2. And that's where you see, as we discussed, this is your proportionate share of the total net loss on the property from a tax perspective. We invest, as many of us do, we invest in real estate because of that net loss. Like I said, we might be getting cash distributions on these properties, but from a paper tax perspective, we are able to show a net loss because of the power of depreciation.
Right.
And you're accelerating your depreciation on that. And this amount is just simply taken by your loss percentage from the section we referenced above. So that I forget the exact amount, the 355, correct, by the total loss of the partnership from this particular entity.
Got it.
The next amount you'll see on the K1 in this example is part 13. And these are other deductions from this 2019 and even the next K1 that next year's K1 we're gonna look at. This represents excess business interest expense. Excess business interest expense is a calculation that's derived it's a deduction for business interest, but that business interest is limited to a certain amount, and that limit is calculated by adding up your actual business interest income. So in this case, we likely don't have any or very little business interest income, and then adding in 30% of adjusted taxable income, which after, I believe it was last tax year, that it does not include depreciation or amortization. So that is allowing that limit, and by excluding depreciation allows us to take a bit more business interest expense. So it limits this, the amount that we're calling excess business interest.
Got it. Okay.
And then just so for the benefit of your listeners, any business interest expense as shown on this section that's not allowed as a deduction is generally carried forward and treated as business interest paid, or it's accrued in the next taxable year. So, it can be factored in to the next year's and taken as a deduction in the following year.
Got it. Thank you. Thank you for that. So if it exceeds the allowed limit, you can
Yeah.
carry it over. Okay.
Absolutely. You'll eventually get the benefit as long as you're increasing your overall NOI,
Got it.
which is net operating income. The next section, which I believe is 19.
Do you want me to make it bigger, Denise? I see you.
Yes. Yeah.
Sorry.
Yeah, that's okay. That's all right. Yeah, no problem. And this is the amount, and we referenced this amount earlier. It's the distribution that you've received in a given year, and is used, which we'll get to at the end of the schedule, to calculate your basis in the property as well.
Okay.
And these next line items, these are other information, so that it can really encompass a bunch of catch-all items. Looking at the 2019 K1 item Z in this example represents something called 199, section 199A information. And it's on the last page of the file, Deepa. I don't know if you want to jump to that.
Sure. The last page.
I think it's the last page. Sorry, maybe it's not.
No, no worries.
Scroll up a bit.
Please stop me whenever you see it.
Yeah, if you can show me the title of, it's not this page, it might be the one previous.
Okay.
Yeah.
Okay.
Can you scroll up a little bit more? No, it's not this one either.
Okay.
There it is.
There?
Yep.
Okay.
Yep. You can see at the top of the screen, it says Partners Section 199.
Oh, got it.
199A information worksheet. Excuse me. So, this Section 199, it provides owners of sole proprietorships or partnerships or S corps a deduction of income from something called a qualified trader business. So you might be allowed a deduction of up to 20% of your net qualified business income. And this is also referred to as this Section 199A dividend. The partnership will provide you information that you need to figure out your deduction, if any. And it's generally available to, I would say, most taxpayers with this pass-through business income. There are, just like anything else with the IRS, there are thresholds for how much income you make. So depending on how much your wages are, you might get phased out of a portion or all of this deduction. But taxpayers with incomes above these levels might still be eligible, but it's still subject to other limitations by the type of trader business and the amount of W-2 wages that you have. So on this particular example, it shows you the W-2 wages that would be considered qualified. In this particular case, it's a loss. But if you had income, you could take up to 20% of that particular amount. Depending
Income.
on if income was in the 23,341, the loss.
Oh,
So
if I had income, got it.
Correct. Yes.
Right, because it's the loss, it doesn't apply.
Exactly. Yeah.
Got it. Okay. Do you want me to
yes.
go back up, Denise?
Yeah, we can go back up.
Okay. Let's go back to the section we were earlier. Over here?
Yes. I believe that's the last section on there. AH is really probably just the wages that were referenced on there. So what are your qualified wages from the example that we just looked at?
Got it. Okay. Sounds good. So this looks like boilerplate.
Yes.
Would you like to tackle this page? Or
this is really an informational page for supplemental information. It's disclosed, but nothing, ultimately really the amount on here, the line 2, the net rental, I'm sorry, above, if you go to the 23, again, yeah, that's really what's relevant. on this page because it's showing your proportionate share of the
Got
the
it.
tax loss.
Got it. Got it. Okay.
And then this is the schedule that supports the tax loss. So I mentioned the items above, the Schedule K subtraction for that excess business interest. This is really just showing you what if you take your loss, but then add back to that excess business interest amount, that is what will be your total loss for the year. So it's really sort of backwards. It's the 24,120 adding in the 779 of excess business interest, and then your net rental loss is that credit, that negative 23,341.
Got it. Okay. Do LPs need to pay attention to this number?
From the perspective of that, if that number were huge, I mean, it's just something that, you'll carry forward to the next taxable year. Some people are really good about auditing their CPA and saying like, oh, this was on my amount last year, but I don't see it as a carry forward item. Usually the software that most CPAs use will automatically carry forward. Anytime you switch CPAs, that would be something that would be relevant to ensure that your new CPA that you engage has that carry forward amount.
Got it. Got it. Makes sense. Thank you for that. That's something we need to remember while switching CPAs is not very easy because there are losses that we carry forward and other expenses that we carry forward.
Right. That's one where, if you do ever switch CPAs, is as real estate investors, many of us have, net passive losses that we carry forward every year. And if you don't get that right from, a beginning of time perspective, that can be a bit of a nightmare because you're going to have to refile previous years if your accountant does
Right.
not pick it up properly the first time he or she prepares your return.
Right. Right.
And then this is just back to that 199A information worksheet that we
Oh,
discussed
right. That
earlier.
we spoke about.
Yeah.
Let us
And
see.
then this is probably something we can spend a little bit of time on. This is our tax basis. So what is your tax basis? It's basically, our tax basis is it's when the owner is within their rights to actually accept income from a property based on how much they've contributed to the in this case the company or property itself. So you can only receive a distribution equal to their percentage of the company. If an owner does not have basis, they're depleting their basis basically and getting more than what they put in. So some of the terms that you'll hear for like basis are, I just wanted to mention some of these because you may hear cost basis and you may hear adjusted basis frequently. And cost basis is your initial investment a person puts into the company itself. So in this example, it would be the $50,000. Your adjusted basis is how your cost basis has changed because of contributions, distributions, and all that good stuff.
Right. Okay. Looks like
So,
basis.
yes. Yeah. So in this particular example, we're taking our $50,000 and we received distributions. So we've received a return on capital of $539. So that reduces our basis to $49,604. And then if you see beneath that, you will actually see that this is our portion of the respective loss in the company. So we take we back out the 23,341 and the deduction of the excess business excess business interest, sorry. And then that gets us to this $24,120 that you're taking off the $99,065. And I think we missed the change in liabilities. Yep, I
Right.
skipped over that by
Yeah.
accident. Sorry. So
No
if
worries.
you went up to, so that's considered your at-risk basis. So it's your proportionate share of the liabilities of the company. So if we went back all the way up to the first page, if you don't mind, Deepa,
Yeah, no worries.
or yeah, that page that we discussed, and you add up the 1387, which is the proportionate share of the non-recourse plus the qualified non-recourse financing. That's your at-risk basis. That's getting to that 49,000 on the cost basis schedule that we just showed.
Got it. Okay,
On,
thank
I'm sorry, that's on the taxpayer basis schedule we just showed. So
you.
that's how that factors in. So you know, it's you want to make sure you keep an eye on this because you know, I don't ever see this happen in multifamily properties, but again, that's your basis in the property from the tax perspective itself. And you do not want to you don't want to deplete your basis and receive distributions on top of that. Unless it's obviously, you know, a year where the property is sold, then your
Right.
basis will essentially go to zero.
Right. Denise, I got a quick question about this. So, this 99,000 is twice as much as this LP invested,
Yep.
right? Um, is it double dipping? Because this capital is at risk, the $50,000 that they invested, and then this is a proportion, but they have not actually invested. This is not cash out of their pocket. This is
Right. But when you think
liability.
about this as a pass-through entity,
Okay,
so you're really from a tax perspective, you're passing through that
everything.
amount
Risk.
into
Okay,
exactly. So that's a tax code specific item. Now in the real world, um, outside of the tax code, is that is that your actual liability? No, it's not, but that's your technically
right.
your at risk, how they consider your at risk basis.
Got it. Thank you for putting in the real world. It is the
Yes,
50,000 that you actually invest.
yes,
In the tax
yes,
world,
exactly.
it is this.
Yes,
But again,
right,
they are taking into account the 24,120 and deducting it. And this is not
right,
a real world number either. That's from,
exactly,
right.
right. That's from
Um,
accelerating your expenses, just
got it.
on you're accelerating your depreciation, right?
Got it. And the end of the year, we end our tax basis at 74,000, almost 75,000.
Yes.
Got it. Okay. Do you want me to keep going?
The rest of the schedules are really repetitive
Got it. Okay.
information. Yeah. So I would say if
Okay.
you wanted to, um, we
Let's go to
can
the next one.
quickly, yeah, go to the next one.
Yeah. All right. 2022. Let's go to this page. And this time we have beginning balances.
Right.
All right. Take it away.
Yes. Interesting. So there is an amount in the recourse
Right.
that here. Yeah. So I would be curious to see I you know if you had some of the details on this property, maybe we could touch base after and then we could
Sure.
talk
Yeah.
about what that would be. I mean, it's a very small amount.
Yeah. But
Um
I have
so
seen
there
big numbers there too, Denise.
have you really?
Yeah.
Okay.
Yeah.
Yeah, I don't typically invest with I haven't seen as many properties with the recourse liability, so that's probably what the difference is. But yeah, sure, I'm happy to dig in once we find out specifically
Right.
what that
You
is.
know, most of the syndications, the loans are non-recourse, right? Because the
Mhm.
amount being borrowed is over $1 million. They're
Right.
all non-recourse, so I wonder why. But yeah, I'm glad to. I'll touch base with you.
Yeah, there could have been, I'm just trying to think if there could have been some pref equity or something that, you know, some sort of agreement on that debt structure that might be different um than some others.
Just a regular lender
Yeah, yeah,
LPs. Yeah,
exactly.
got it.
And then you'll see, you know, the beautiful thing that accountants like to see is the ending from 2019 should agree to this beginning capital account. And then you'll notice this year in 2020, which is the second year of the hold period, there is depreciation. So there's still the net loss, but it probably was the case that net operating income increased. There was only it looked like there was only about 9 months or 8.5 months that the property was held in the previous year, and then a full year of holding in this 2020 period. So, and there's less depreciation likely being taken, so your net loss is going to be less than 2019 as well. And
Right.
then your distributions were higher, which is always a good thing. We had a full year of operations in 2020. You received $2,559 of distributions. And so that leaves us with a net basis of a little over $19,000.
Right.
I'm sorry, not basis, capital account.
Capital. Right. Got it. Okay, thank you. So we keep going to part 3.
Yep.
You can see some real estate losses here too, net losses.
Yes. And that's our net loss. So that would be the depreciation. And then you have to add back in that excess business,
Right.
excess interest expense.
And these two together should add up to this number.
Correct. Yes.
Okay. Okay,
Yep.
thank you. And
Yep. And then you'll see the distributions
Right.
tie out to the capital account. And then
Right.
again, it just really takes us, the last two items are the same, that section 199A information that we discussed on 2019's K1 as well.
Got it. Thank you. Okay, I'll keep going. So this, you said, is the informational page. And here, oh, is the same numbers.
Yep, these are
Right.
the same amounts. So you'll see, you know, if you add back in that excess business interest expense.
Right.
And then again, this year, this is at qualified business income credit, that calculation you would do. But again, this is an overall net loss.
Right.
And these were your qualified wages that could potentially go against that amount. But again, it's a net loss.
Right. Could you please explain what the qualified wages are? Denise, the 63 grand, I should have asked you in the first one, but
Yeah, you know what? I did take a note because honestly, I don't remember off the top of my head how they calculate it, but I did
yeah.
take one note.
Yeah. No, you don't have
Just
to
bear
talk
with
about
me.
how they are calculated.
Mm-hmm.
I'm just wondering, if I was an LP looking at this number, do I need to pay attention to it, and how it would affect me is what?
So you would pay attention to it in the sense that it's another deduction you can take if there's income. So that qualified business income credit, it's, you know, again, it's generally available to most taxpayers with this pass-through income, business income. But your overall taxable income has to be below the IRS thresholds. And then your income above these levels can still be eligible for that deduction, but it's subject to all the limitations based on the type of that trade or business that the partnership is actually involved in. And then your amount of W-2 wages paid by the trade or business and the unadjusted basis immediately after you acquire a qualified property.
Oh, this is what the property has paid
Yes, yes.
to staff, full-time,
Yes.
part-time to staff.
Yes.
Got it. Okay.
Exactly.
Okay.
Yeah, when I say your, sorry, I mean the
Right.
business.
No, I completely understand. That's what I was trying to
Yes.
do. 63. Okay. And I see that this is the same number from the
Yes.
previous year, and this is the beginning balance.
Yep.
And
There's our distributions.
and this is the same number, current year,
Yes.
prior year.
Yeah, so you're only getting credit for the change in the liabilities. So
Got
your
it.
basis, you know, is going to be adjusted by that change from the prior year.
Got it. And there was a little bit of change, and there was $26 or so in
Yes.
in the
Yeah,
other
they're
column in the
proportionate.
report.
Yeah.
Yeah. Okay. So all of that, and the subtotal is 72, and let's see where it goes from here. And
Then we have our 1579, which is our overall loss, but then you have to also add in the deduction that took place because of the excess business interest.
Got it.
So your total basis is adjusted down by that 3686 to about $68,000.
Got it. Thank you. So this is where we end the second year of hold, the
Correct.
year of hold.
Yes.
And I guess this is all repetitive. We can go to the third year where I'll assume the property was sold. So here, there we go. Let me make this bigger. Can you see my screen, Denise?
Yes, I can.
Okay, perfect. So
Okay.
I've noticed that these numbers don't change at all
Yes, they do
because
not.
that's from the PPM and
Right.
should not change, right?
Right. The interesting amount is that does look to be a small amount of ending income, I'm sorry, ending recourse, which
Oh, the
I would expect
26?
that number to
Yeah.
be zero. No, no, in the ending amount, if the
Oh, the
property was
8.
sold.
Oh, wow.
Yeah,
I didn't
yeah,
even see that.
yeah. I don't know if that's just a big rounding issue or I'm not sure.
Yeah,
So yeah, this is so you can see in the third year there's a lot less depreciation being taken, and NOI probably significantly increased again because I'm assuming you executed your business plan and were able to you know, renovate the property itself and force appreciation via increasing rents and all that good stuff. And then your withdrawals and distributions are at the $118,000, leaving you with an ending capital account of $3,672.
got it. Okay, so this is pretty much where we started
Yep,
and the losses. So this is a gain because it's a positive number,
correct. Yes.
and this is the
But
withdrawal.
then that's the withdrawals and
Right,
distributions taken. So
right.
I'm assuming that remaining amount is something that was paid out maybe the subsequent year, or there was some sort of timing, I would guess. Um, but I'm not completely sure based on, you know, this not being one of my properties.
Got it. Yeah, yeah. No,
Yeah.
thank you. We appreciate you doing this.
Yeah. And then this is the overall, you know, between the I guess this is backing out the overall gain associated, your proportionate gain associated with the sale property. This is what the rental real estate income, or in this case, a slight loss would look like for the year.
Right, the 709 and then
Yep. And then you have this 1231 gain, which is really just your capital gain, your proportionate share of the capital gain resulting from the sale of the property itself.
got it. And that number, so the capital gain number, I've noticed is
Mm-hmm.
always different from the distribution number. This
Mm-hmm.
must be a calculation,
Yes,
right, Denise? Yeah,
it
this is
is.
proportional to
Yes.
how much. Okay,
Yes, exactly. And that's different than your distribution.
got it.
Correct.
And I do see that there's AE here this
Yes.
time around.
And
Last
we should be
time.
able to scroll down and see exactly what the detail behind that
What?
is.
Okay,
It says, because it does say to see schedule. Um, hmm.
I should be here.
No, this is our
Oh,
basis
this is the basis.
calculation.
Right. Okay, I'll keep
Uh,
going. I'll keep going down.
okay.
Please stop me when you see. Okay, we're at the end. So let me go back. Let me go back up. So this number is what we're trying to figure out.
Right, right.
Number
Yes,
four, AE.
that goes back to, I believe, still a component of section 199, but I don't think I
Okay.
saw it on that
Yeah, I don't see
schedule. We
it
can
here.
look again.
199. Okay, that's not it. There's 199.
Okay.
And yeah, I don't see that number.
No, I don't either.
Okay, that's interesting.
Yeah. Maybe we just uncovered an issue by the no, I'm just kidding. I'm kidding.
Everybody does their taxes differently, all
Yes.
syndicators, and yeah.
Yeah.
But that would be a good question. Um,
Yeah, absolutely.
so where would this number tie at all, Denise? Like if we have to check the correctness of this form, would it tie in anywhere else to balance?
That's where I was thinking all of these other information, I believe, relate back to the 199A. That's why I was looking to see
Oh,
where what that was comprised of.
Yeah,
So without, the overall partnerships
right, right.
return total,
It would
it's
be
hard for
difficult.
me to, yeah,
Right.
it's hard for me to figure out exactly what that number
No,
what it represents.
I completely understand. I'm trying to see if I can
Yeah,
find that number anywhere,
yeah.
but
No, I don't think
yeah,
I know. I just quickly did some math on some of these other pages and I'm not getting close to it.
yeah. But that's completely fine.
Okay,
We could go through,
sure.
yeah, our partners basis and
Yes, exactly. So that 68,000 looks familiar from the
right,
2020 return that we reviewed.
right,
Our section 1231 calculated gain is right there, and then that's offset by our distribution. And then we're backing out our change in liabilities again. So at the end of the year, there's that straggling $8
right,
proportionate. And then so that gets us to a $4,389 amount. And then we have to reduce that by our rental real estate loss.
right.
So that would be the loss before any before the actual capital gain event.
Got it, got it. So this is maybe through the few years the property was held in that year.
Yes,
Um,
exactly. That third year of
right,
ownership.
right. And the ending balance is end of year, end of balance is
Yes,
okay. No, thank you so much for going through all of this. Um,
sure.
so one quick question I had for you, Denise, is
Yeah.
can a LP
Mhm.
offset paying taxes on a distribution like this one?
So what you would do, and that goes back to tax strategy. So in years where we have properties that we are selling, I make sure that I have one of two things. I either will 1031 that gain into a property of greater value. So there's a whole bunch of rules and regulations around 1031 exchanges. Truthfully, the timing doesn't always work out, as we know. You
Right,
might
right.
not be able to sell a property, and then there's very
Yeah,
specific timelines between when you have to identify the next property that you're going to purchase if
right,
you want to defer that capital gain. So, that's always a beautiful option if you can make the timing work. If you cannot, what you can do if you're an investor, you can invest into another property. And that property is going to have, you're going to take the money from this particular gain on sale. And, in this case, looked like it was a very good investment. But then what you'll do is you will take that amount and you will invest a portion of that amount or all of that amount into another property, and then you will get depreciation on that investment. So again, that depreciation in the new property, that tax loss is going to offset your capital gain from this particular property. So that timing of transactions and knowing what's going to happen within, your taxable year is a key component to tax strategy, and
right,
making sure
right,
that someone's looking out for you from
right.
that perspective. And then if you have other passive investments, I believe you are as well, Deepa. I'm an angel investor. If you happen to have an exit from that year, you have a big, income, income gain from that investment. You
Right.
can take depreciation, anything passive. So all of those amounts, I know, again, that's something that not I hate to sound like this, but not all CPAs are created equal. Sometimes people will tell you cannot offset certain passive activities with other, different passive activities. That's not true. You can invest in a business. You can use all that activity that you're, again, it has to be passive. You're not materially participating,
Right.
and you can offset those too. So really that timing is key from a tax planning perspective. And
You.
just to bring it home, I always think back to this. When I was when I was in public accounting and somebody, said this to me, it really stopped and made me think. When you think about taxes as being our biggest expense, as individuals, it
Right.
really will frame your perspective on tax planning, and really thinking through tax impact of transactions. So I'm cursed with not being able to think about anything but from an after tax perspective, so even if, so, I preach diversification. I'm not all real estate. If something in my portfolio, doubles in value, I don't just think, oh my goodness, great. Now I'm going to get, another $100,000 of income. It's everything is after tax in my head,
Right.
which is the way you really should be thinking about all of your income streams.
Right. No, thank you for that. You mentioned 1031 and
Mhm.
for limited partners. Um,
Yes.
would syndicators be willing to accept smaller amounts?
So it depends. I've worked with syndicators who have, if they can get one large 1031 investor, then
Right.
they will let in other
Right.
1031
They can
investors
piggyback. The other
gladly.
smaller ones
Yes.
can piggyback
Yes.
in.
And
Yeah.
we've had I've had, one or two properties where we've been able to meet that threshold. The latest property that we partnered on, I believe we were trying to get, in total above $750,000 for it to be worth it for all of the administrative components that go along with it.
Right.
So yeah, I mean, it just depends. It has to be just anything like kind though. So keep that in mind. It doesn't have to be in the exact same asset class.
Right.
So keeping that in mind, and when you're going to invest, truthfully, as I said, from a timing perspective, um, the 1031s don't always work out. When you have something sell, you don't have typically the next,
Right.
beautiful property waiting for you. So what we tend to do is time those transactions and invest in another property, that will provide us with plenty of depreciation to offset that gain.
Got it. Thank you. And reinvesting the gains is also always another possibility where you can rack up more passive losses, and the passive
Exactly.
losses from the new investment
Mhm.
can offset the gains from this particular investment. So,
Correct.
yeah, and that's the beauty, right? We just try
Yes.
and grow the money and
Yes.
keep rolling it
Yeah.
tax free.
When you think about it from, a purchasing power point of view, I want to hold on to my gross amount of, investments,
Right.
investing portfolio as long as I can, because a dollar today is worth more than a dollar tomorrow, and we're gonna have more control and more value, in those investments. So, people might just say, oh, we'll just pay the tax on it, but really you want to keep rolling that because of the power of compounding.
Right.
And when you think about it from the perspective of the power of compounding your wealth, it's, as I said, it's just um, it's a key advantage to growing your wealth.
Right. Right. And if you pay your taxes, I mean, we have to pay taxes at some point, but if you pay
Hmm.
your taxes today, you have that much less to invest. And if you hold on to
Exactly.
your gross, then it's a bigger down payment on a bigger property. So,
Correct.
right,
Yes,
right.
exactly.
Yeah. Well, thank you, Denise. This was very, very
Sure.
informative. How can
Absolutely.
our listeners get a hold of you?
Sure. Feel free to reach out with any questions. You can reach me at, Denise at ONE Street, no S, capital.com. Happy to help in any way, any questions. And again, we'll try not to bore you to sleep. Hopefully we didn't bore anyone, during this one.
No, it was really good. Thank you. Because as an LP, you want to have that knowledge of to how to read a K1 and how to
Yes.
and we found the straggler $8 and the $26. We're like, what is that from? They're not big numbers,
Right. Right.
but it's good to
Exactly.
know what you're liable for. So
Absolutely.
yeah. Denise, thank you so much. We really
You're
appreciate
welcome. You're welcome. No problem. Thank you,
it.
Deepa.
Yeah, bye.